The world's greatest geologist is on the verge of his next billion-dollar discovery. With looming shortages in copper, zinc, gold, and silver, this may be the best opportunity hard asset investors have ever faced. Learn more at futuremoneytrends.com/hardassets.
Well, hello everyone, and welcome into crushthestreet.com. My name is Kenneth Amaduri, and today I have a special guest. I'm with Andy Schectman. He's the president and owner of Miles Franklin. They're a trusted bullion dealer, and I'm looking forward to talking with him about the boots-on-the-ground experience of what's going on in the actual bullion market, since they are a bullion dealer. They're a trusted bullion dealer. So, Andy, thanks for joining me today.
Hey, Ken, thanks. Good to be here. Appreciate it very much.
Well, like I said, I just wanted to kind of get your initial thoughts on what's going on right now in the precious metals market. Obviously, you own a dealer, so what are you seeing right now with gold and silver and some of the other commodities that are out there?
You know, Ken, I've had a view on what's happening price-wise for a few years now, and every interview I've given over the past 3 years, every speech that I've given at the trade shows around the country, I have talked about an idea that I see. I'm going to go back to 2008 to set the stage for why I see things the way that I do, and I'll let you decide and your listeners decide for themselves if it has any merit. Caveat to all of this, it was the only thing that made sense to me in a world that had all of a sudden been turned upside down. You don't have to be an econ major to understand that the very basic premises of the law of supply and demand and how they are supposed to, according to the textbooks, move inverse of one another. Back in 2008, I noticed something that was, I think, very unusual at the time, but has become somewhat of more commonplace here since, and that is that we saw a major disconnection between the price of the metal and the demand for the metal, or the inability to source product. In 2008, we saw gold fall from 1,000 to 700. At the same time, we saw silver fall from 21 to 9. And in that environment where the underlying asset is falling by 30 and 60% respectively, one would think, according to the laws of supply and demand, that the demand for investment A and investment B falling 30 and 60% was non-existent. One would think that there was a situation, in fact, of a dumping of supply onto the market to create such a windfall, or a waterfall, shall we say, waterfall of prices from levels that, 1,000 to 700 is a scary event if you're in the middle of it, and 21 to 9 is terrifying if you just bought silver. One would think that supply is being dumped. In that environment, within a few days, every major dealer, every major refinery, and every major mint, U.S., Canada, South Africa, Austria, and Australia, were sold out of product. Every one of them. The Perth Mint shut down in August of that year, took no new business. The Rand Mint in South Africa ran out of product for the first time in 40 years. The Royal Canadian Mint and the Austrian Mint were working 24 hours a day, 3 8-hour shifts, and they were back-ordered as long as 12 weeks. The U.S. Mint shut down over 6 times in 2008. And Ken, so if you wanted to buy gold, you'd call me up. Once they finally allowed it, you'd call me up. You'd pay incredibly high premiums, and you'd wait 12 weeks to get it with your money up front. The premiums on Silver Eagles and Silver Maple Leafs, when that happened, anywhere in the country approached 100% with 3-month delivery delays. In other words, we had $9 silver, and every dealer in the country was selling Silver Eagles or Maple Leafs at $17 to $18 with 3-month delivery delays. Everything dried up as the price went down, which makes absolutely no sense. And so from that point forward, I had to rethink, how is it that the price can be managed down in an environment that would dictate otherwise? And in that environment, which one would think, a la laws of supply and demand, that supply would be flowing, pick and choose whatever the heck you want, it was anything but that. There was nothing to be found. I was told for days on end, in fact, weeks on end. There is nothing to get. Every major mint is gone and out of product. Every refinery gone and out of product. It became my biggest single concern. In fact, it is what I have felt ever since then would define the landscape going forward. And so if we look at what's happening now and we move forward several years, you look at like an example like today. I believe that the big money, the powers that be, the Chinese or the commercial banks or whoever you want to call them, is manipulating the market in two ways. And they're doing it for one reason, but they're doing it in two ways. The reason they're doing it is to misdirect the public into believing that the road to retirement is only paved with mutual funds and stock certificates so that they themselves can reposition out of dollars. And the way that they do it is both counterintuitively to what's happening. Look at what's happening today in Greece. One would think gold and silver should be off the charts, but it's barely higher today. As the last thing the powers that be want, or the big accumulators want, are people rushing to gold and silver and in favor of in lieu of currency. They do not want to create a currency panic. They do not want people to realize that there are alternatives. And they'll also do it technically. They do it technically by pushing the price down below resistance levels and moving averages. And if you do that, realizing that most of the Western world uses technical analysis to gauge their investment direction. If you can push the price down below moving averages and technical resistance levels, you get the hedge funds and the mutual funds and their algorithmic trading programs selling indiscriminately. No emotion involved. They just sell. You get the financial advisories who, even if they themselves don't understand technical analysis, someone in their corporate office does, publishes a newsletter for all of the brokers to read, and says commodities look horrible, all the way down to base metals, precious metals, fossil fuels, you name it. All of these important commodities are being managed lower, not only counterintuitive to what is happening, but also technically, more importantly, getting the big money out, and the hedge funds and the mutual funds, all the way down to the Edward Jones franchisee who's reading the Edward Jones corporate newsletter that says commodities look bad, equities look good. So at the same time they're shorting the commodities with a tremendous amount of leverage, they're also goosing the equity markets. When you talk about the leverage that they're able to do this on the stock market, they're mandated to 2-to-1 leverage. You can't be more than twice levered in the stock market. But in the commodity markets, it's nothing like that. Right now, roughly just over $3,000 covers a 100-ounce gold contract. So $3,000 controls 100 ounces of gold. That's roughly 35 times levered. So you can lever 35 times on these commodity markets, at least in the gold market, and create quite an effect without burning all of your bullets. So what they do is they drop the price down counterintuitively and technically. They get everyone out, and they're able then, at subsidized levels without any competition, buy up all of the world's supplies, all of the physicals. And when it's all said and done, they will sell their treasury positions, I believe, to cover their shorts. And they'll be out of everything dollar. They'll be out of dollar bills and treasuries. They'll use their dollars to suppress all of the commodity prices, to get everyone misdirected like the no-look pass in basketball. They're dribbling down the lane and they're no-looking. They're looking to the left and bounce passing to the right. They want everyone going to the left, following the equity markets that are being goosed, while they suppress the commodity markets with the dollars they're choking on to create a new reality. A new perception of reality. And as big money gobbles up all of the world's commodities on the cheap without competition, and then slowly sells their treasuries to back out of their short positions, they'll be out of everything dollar and will own all of the world's commodities on the cheap. I do believe things like that are happening right now, and people are being misdirected by price rather than looking at the fundamentals, the mathematics, and the economics of it. And since 2008, very little other than that has made sense to me. And so I do believe that right now, the most important thing to do, Ken, and the most important things for your readers to do and your listeners to do, is to not, as difficult as it sounds, is to not focus on price. Focus on mathematics, focus on economics, and focus on logic. And I think in that respect, it leads you back to protecting oneself with precious metals, not trying to become wealthy owning them, but realizing that inherently all currencies are meant to die, and our dollar is very close to the chopping block. So I think that right now, more than anything, you buy gold and silver through the logic of it, through the mathematics of it, and you don't focus on price. And I think in the end, that is the best you can do right now, because if you look at price, you're going to be misdirected and driven crazy.
Well, talking about people and the general public, in your experience, when are people most eager to purchase precious metals? When the price is collapsing, when the price is going up, or kind of where it's now, where it's kind of a little more stagnant? And I guess my indirect question is kind of talking about human emotion, because it's easy to say, oh, buy when it's down, or don't just get too anxious when the price is going up. But we all deal with human emotion at some point, especially when we're dealing with fast-moving prices. And I'm curious, what have you seen at Miles Franklin with this?
Well, thanks to guys like you and your cousin Daniel and many other people out there, our newsletter, all the people out there who are making a contribution to getting information out to the public, I would say that the people who buy gold and silver, the people that are tuned in, are more tuned in than most of the public. What I mean by that is that when the price falls, we do more business with people who are tuned in, the people who pay attention to what's happening out there, the people who listen to you and to Daniel and read our newsletter, and the people who read Casey Research, and the people who are tuned into what's happening in this environment. When the price goes up, you get the public. You get the people who aren't purchasing things the right way. When I became a stockbroker many years ago, the page 1 of the manual that you go to a week-long class, page 1 was the little man rule. And the little man rule basically was that the little man never wins, because the little man always is late to the party. When gold and silver were much higher, we were getting 200 phone calls a day. And most of which was new business, and I would consider it to be the little man. People who had heard about gold and silver and were buying it to make a profit. They weren't buying it for the same reason that the people listening to you right now would be, and that is because they understand the mathematics. They understand that 1 trillion seconds ago was 31,688 years ago. They understand that in order to pay off an $18 trillion debt and nearly $200 trillion in unfunded liabilities, by the government's own admission, you can't. It's impossible. The numbers are too big. They are buying gold and silver because of the logical, mathematic, economic reasons behind it. The little man, or the person who buys as prices are going higher, is chasing the bandwagon in search of profit. And I think that the bottom line is that I would say at large the precious metals community is well informed and understands that you buy when prices are correcting, especially in an irrational fashion. Prices are correcting and it doesn't make sense. Greece is imploding, gold should be going to the moon, and that terrifies the people who are trying to keep a lid on things, who are trying to control things. And so I think the bottom line is that human emotion definitely plays into everything we do. When price goes higher, we get more of the public involved. When the price goes lower, the public is absent, but the smart investor who's buying precious metals for the right reason is more active. And when the price does nothing, you might as well go out and play golf, because when the price is in a tight trading range, it's a very difficult market, and it's a very difficult mindset for most people, in that things don't make sense, things aren't moving, and they're waiting for the next shoe to drop. In the respect that prices have corrected an awful lot over the last few years, and it's been a rough time. And when you see a tight trading range, counterintuitive to what's happening, and one that is reluctant to move higher and seems like it wants to fall in this tight range, you get a lot of people that are either frightened or completely turned off by the sector. And again, that falls into what I believe is happening. Big money is trying to misdirect the public out of this market, and the greatest way to do it is by emotions. And if you can elicit a different emotion or a different reality through their market mechanisms, then they win the game, because the last thing they want is the rest of the world realizing perhaps what you and I do. And the last thing they want is people running to gold in favor of currencies and equities and traditional forms of ideology. So, bottom line is that you have to try to take emotion out of this, and it's a tough thing to do, but as far as I'm concerned, the people in this industry and the people who are listening to your podcasts are fairly well informed, more so than the majority of the public, who seem to react to when prices are moving higher.